The stocks and investments issue. The principles discussed in this lesson are stocks, stock tables, bonds, and mutual funds. Understanding stocks. A share of stock is part ownership of a company. A company issues stock shares to raise business capital, and investors buy shares to participate in the future growth of a company. You own a part of the profit generated. Dividends are the investor's share of profits, usually paid semi-annually or annually. The more shares you own, the larger portion of the company and profits you own. Stock market, a market linking buyers and sellers of securities, approved and regulated in the United States by the SEC or Securities and Exchange Commission. Types of stock. Stock represents ownership in a company. There are two types of stock: common and preferred. Common stock owners elect directors who hire the day-to-day managers of the business. Owners vote on issues at the stockholders' meetings. The board of directors determines what is done with any profits. Preferred stock owners are paid before any dividends are paid to the common stockholders. Like common stock, preferred stock represent ownership in a company, although preferred company does not have to pay this dividend if it lacks the financial ability to do so. Stock advantages. Stocks have higher potential growth, thus higher potential reward, than a cash investment such as a credit or certificate of deposit, money market account, or a fixed investment like savings bonds. This is because the investor assumes risk of ownership in a company. Historically, the long-term capital growth of stocks has outpaced the interest paid on fixed investments. Stock disadvantages. However, stocks have a higher risk than fixed investments, some of which are backed by the Federal Deposit Insurance Corporation, or FDIC, or even government bonds which pay a known rate of return and are backed by the full faith and trust of the government. A single stock investment is especially risky because it lacks diversification, which is the strategy of investing in a variety of assets expected to react differently to changes in market conditions. Stock mutual funds tend to have less risk because they are more broadly diversified. Understanding the stock table. This slide illustrates a typical newspaper stock table. Here is how to read it. The first high-low column shows the highest and lowest prices at which the stock traded in the past year, or 52 weeks. In our example, the highest price was $47 and the lowest price was $37. SYM is the abbreviated name for the firm issuing the stock, the ticket symbol.
You need tardy slip. If you get that teacher to...
DIV refers to dividends, the annual amount per share the firm pays to its stockholders. In this example, $2.30. VOL refers to the volume of shares in hundreds that were traded that day, which gives an indication of the size for the market for this company. YLD refers to the dividends yield, or the return on invested capital, calculated by dividing the amount in the DIV column by the amount in the close column. The closing price of the stock. PE signifies the price per earnings ratio and shows the amount an investor is willing to pay per $1 earnings per share. It is calculated by dividing the price by the earnings per share. High-low represents the highest and lowest amounts the stock was traded for during a trading day, not over the course of the year as in the first column. close is the price at which the last trade was made during the day. Stock prices are traditionally reported in eighths of a dollar. Net charge stands for the difference between the closing price of the previous day and the closing price of the current day. Understanding bonds. Bonds are debt securities, IOUs issued by corporations or governments. The investor loans money to the corporation or government that needs funds for a defined period of time at a specified interest rate.
Give me your device.
In most instances, bond issuers agree to repay the loans by a specific date of maturity, and to make regular, usually annual or semi-annual interest payments to the investor until that date. That's why bonds are referred to as fixed income investments. Types of bonds. Bonds can mature at different times. They can be short term, less than 5 years, intermediate term, 5 to 10 years, or long term, more than 10 years. Corporate bond, a bond issued by a corporation. Municipal bond, a bond issued by state, city, or local government to finance operations or special projects. Generally, the interest earned is tax-free. Treasury bond, a bond issued by the U.S. government considered a safe investment because the taxing authority of the United States government backs it. Terms are for more than 10 years. Issuance of the 30-year bond has recently been suspended. Treasury note, same as Treasury bond except that the note is issued for a shorter time, typically in maturities of 2, 3, 5, and 10 years. Treasury bill, an instrument issued by the United States government. Maturities range from 3 months to 2 years. U.S. savings bond, government issued and backed by debt instruments that makes periodic interest payment. Zero coupon bond, bond with no periodic interest payments. The investor receives one payment of principal and interest at maturity. Selecting bonds. Factors to consider before buying bonds. Issuer. Bonds are issued by the U.S. Treasury, U.S. government agencies, corporations, and state or local governments. The issuer affects the credit risk defined below, which in turn affects the price. Maturity. Date when the issuer agrees to repay the principal or face value of the loan. The longer it takes the bond to mature, the more it will fluctuate with changes in interest rates. Short term is more predictable and less risky than long term. Credit quality. A bond's quality is measured by the issuer's ability to pay interest and repay principal in a timely manner. Treasury bonds have the highest credit quality, and corporate high-yield junk bonds have the lowest credit quality. Risks. Call risk is the risk that an issuer will opt to pay off some or all of its bonds before the maturity date, forcing the investor to find a new source of income in a lower interest rate environment. Not all bonds are callable. Credit risk is the risk that an issuer will default or fail to pay principal and or interest on the bond. Interest rate risk is the risk that rising interest rates will reduce the value of a bond. This applies if the investor plans to sell before maturity. Bond advantages. There are several potential advantages to buying bonds. Bonds tend to be more predictable than other securities. They provide a source of fixed income for a defined period of time. Bonds generally offer higher income than cash investments such as money market funds, CDs, etc. They generally produce more income than stocks because stocks tend to focus more on capital appreciation than income generation. Having bonds in your portfolio provides diversification that can reduce overall volatility. Income from some bonds is tax exempt. Understanding mutual funds. A mutual fund is a regulated investment company run by a manager or team of managers that buys and sells securities for individuals and institutions to achieve stated investment objectives, which vary by fund. Aggressive growth. Higher risk investments that offer potential for higher returns. The goal is rapid growth of capital. These funds often invest in small or emerging companies. Growth. The goal is increasing capital. Growth companies are usually more mature and have established a very strong market position in their industry. Growth and income. These funds pursue both the increase of capital and current income. Balanced. These funds invest in a combination of stocks and bonds. The allocation percentages are usually fixed, and these funds generally have at least 25% of their assets in fixed income securities. They seek both income and capital growth. Income. Funds with this objective exclusively seek income from the interest and dividends generated by their investments in fixed income securities like bonds, bills, or cash. Categorizing mutual funds. Mutual funds are generally categorized by size, investing style, and market. A fund's prospectus will include information on all three. Size. These definitions are provided as a frame of reference. They may vary from one mutual fund tracking service to another. Small cap stocks are defined as those of companies whose market capitalization is less than $1 billion. Mid-cap stock companies have market capitalization between $1 billion and $10 billion. Large cap companies are those with over $10 billion market capitalization. Investing style. The two main investing styles are growth and value. They tend to alternate in and out of favor. Growth investing is a strategy of buying stock with increasing earnings with hopes that the earnings will drive the stock prices higher. Growth stocks are usually more volatile than value stocks but have delivered similar returns over the past 20 years. Value investing is the strategy of building stock or buying stock at a price below what the investor thinks it is actually worth, with the expectation that the prices will go up and the investor will sell at a profit. Market. A mutual fund may be classified by whether the assets are invested in the domestic market, which includes stock or other securities registered in the United States, or foreign markets, which includes securities registered outside the U.S. Many funds have holdings in both markets. Classification is based on which market holds most of the fund's assets. Evaluating a mutual fund. Mutual fund value is determined at the end of each trading day by calculating net assets. Net assets are divided by the number of outstanding shares to determine the net asset value per share, which appears each day in the newspaper. That's the price investors would get if they sold shares that day. The offering price is the paper may be the same or higher depending on sales charges. Performance is measured by calculating the gain or loss in net asset value from the start of the measurement period to the end of the period. Mutual funds distributions include capital gains and or income dividends, which may be taken in cash or reinvested in additional shares. Capital gains distributions are the prorated share of net gains realized by the fund on securities sold that year. Income dividend distributions are prorated share of interest and dividends earned on securities in the portfolio after expenses have been deducted. At the end of January each year, shareholders of non-tax qualified accounts receive an IRS Form 1099, which reports fund earnings paid as distributions through the year. Advantages and disadvantages. Mutual funds can provide an easy way for investors to diversify their portfolios by adding foreign or global companies. Professional managers select and monitor securities so the individual doesn't have to. Open-ended mutual funds can be liquidated at net asset value on any day the national stock markets are open. Many funds are well diversified and can function as the core of an